Hey everybody, it's Brian Shannon from alphatrends.net. Today is Friday, the 1st of September, and we've got a pretty slow market. So I want to do a quick little video here about the 200-day moving average and the difference between a stock in a downtrend and a stock where that might be experiencing a dip. One, I first learned about the 200-day moving average and the 50-day moving average from William O'Neill and the Market Smith and IBD products. This is a picture, a chart of the NASDAQ 100 through today, right now, midday. And this black line is the 200-day moving average. An old institutional phrase is bulls live above the 200-day moving average and bears live below it, meaning when we're below a declining 200-day moving average, of course we can get rallies, and if you're a trader, you can take advantage of those by looking at shorter-term time frames. But from an investment standpoint, don't expect those rallies to stick. And that was exactly the message of the market that was confirmed in 2022 during that bear market. Early this year, we started to get back above that 200-day moving average, and you see that it started to flatten out and then turn higher. At this point right here, basically at 313.75, that's about where I look at this market and say that's where we officially went to a bull market, because we made a higher high above a flat to rising 200-day moving average. If that sounds familiar, it's because you've heard me say that about the shorter term time frame and the 5-day moving average. So we're talking different time perspectives, of course. Right now we're talking about a daily time frame or even a weekly time frame. If you look at the weekly time frame, that 200-day moving average is going to be closely mimicked by the 40-week moving average because there's 5 days in a week. So let's take a look at some basic concepts about the 200-day moving average. One, if you're an investor, you can look at a stock and see that it's down a bunch, and it's tempting to think, hey, it's a good deal. I see a lot of, I just point to that on Twitter that, people have been doing that in Disney, and Disney's in a horrific downtrend. There's just no reason to be early. You're going to just spend all your time in an asset that's declining until finally it turns, and you've got plenty of time for it to turn, and we'll talk about a couple examples of that. So be aware that, when the market is below a declining 200-day moving average, and when I say the market, that's interchangeable for an individual stock. If an individual stock is below the declining 200-day moving average, the rallies are typically going to fail. The steeper that 200-day moving average is declining, it's even more likely that it'll fail. Every once in a while, you can point to a great example, an exception to the rule, but typically they're going to fail. So what you want to look at, especially from an investor standpoint, where are we in relation to the 200-day moving average, above or below? That makes a difference. We'll talk about some examples here. What's the direction of the 200-day moving average? And just because the market might get above the 200-day moving average quickly, do you want to chase that? And that comes down to risk reward. Asking yourself, answering these two questions. Where has it come from? Has it expended a lot of energy getting to that point? And two, where does it have the potential to go before it's likely to encounter a source of supply which might become resistance? So let's take a look at some examples. AMC, I've seen people all year and all of last year trying to buy the dip in here. This is not a dip. This is a horrible downtrend. It is guilty until proven innocent. There have been some terrific rallies in here, no doubt, but every single one of those rallies has failed. And when we look at it, what did I just do there? Close that. I was looking for a pen so I could draw on this. Where's my pen? Is that a pen? No, I don't know what that is. Okay, I'm back. We've got a highlighter that I can use. So, again, the declining 200-day moving average. We've seen some great rallies. The stock rallied more than a double in here. And if you're a trader, take advantage of trading and trade that to the upside. But recognize, with a declining 200-day moving average, these rallies are guilty until proven innocent, and it's more likely that they're going to continue lower. Here's the thing, too. When you're in a downtrend, the sum of the declines is going to be greater than the sum of the rallies. That's what makes it a bear market, lower highs and lower lows. Don't waste your time with stocks like that. Here's an example with AMD. And AMD was above the rising 200-day moving average and fighting actually above and below. When it crosses above and below, it often represents it's close to a turning point. And in this case, the 200-day moving average was rising right up into here. But it doesn't mean you're just going to hang on to the stock. Even for an investor, you might say, hey, if it breaks below that low, then I'll get out. But then we see lower highs and lower lows below a declining 200-day moving average. Guilty until proven innocent. Sure, you can trade these rallies, but recognize they are just trades. Then the market rallies above the 200-day moving average. It pulls back and finds buyers there. To me, this is the point where you want to be a buyer. If you miss this rally, well, then guess what? You wait for the next pullback. You don't buy a dip. You buy strength after the dip and take advantage here. Now AMD is currently in a decline. Maybe it's going to do something like this, and in a week or two, we can buy it above that next level of consolidation. BLNK was a big story that just got smashed. It was a EV charging play, and again, same story: lower highs and lower lows. Guilty until proven innocent with a declining 200-day moving average. Just because it's down a lot from a price that you previously recognized doesn't make it a good bargain. Brand name companies like CVS, once they start crossing above and below that 200-day moving average, it's representing a decision. And then when that 200-day moving average starts to decline, the sellers are in control. Don't be sucked into the little, earnings report in a downtrend, analyst upgrade, something you saw on TV. These stocks are just garbage. Disney, same thing. I actually made this chart last night, and here today it's down, somewhere in here. Anyways, a brief period of time it was crossing above and below. And over here, it looked like it made a higher high above that flat to rising 200-day moving average. So maybe you bought there, and that's fine. But it breaks down, you got to get out. That's what stops are for. It's not a trading system. It's just something to tell you who's in control, the buyers or sellers. Even if you sold on that gap lower, you've saved yourself a lot of money and a lot of headache. What is that? Okay. So Dish Network, terrible stock. Awful, awful stock. Does nothing but go down. And people will say, hey, that's a double bottom. And that's not what a double bottom is. It's just a level of support that's most likely going to fail. Guilty until proven innocent. It's more likely to continue in the trend down. Generac, this is a great story stock. It makes sense that people are getting generators with all these fires and storms and hurricanes and that sort of thing. And you can see some good rallies, but with a declining 200-day moving average, they're more likely to fail than continue. And here now, finally, the 200-day moving average is flattening out. Maybe this is something to consider for the future here to put on your radar and see how it sets up over the next coming weeks and months to see if maybe Generac can turn the story around and begin a new uptrend. Google, we saw guilty till proven innocent. Rallies above the declining 200-day moving average. If the 200-day moving average is declining, be highly suspicious. Be highly suspicious. But when it starts to turn flat and then we see a higher high, that means the buyers are in control. You can buy here with your stop under here for an investor. And then as it rallies up, you wait for the next pullback. It starts to rally again, set your stop under there. Now an investor might have their stop here. So you would have gotten involved at maybe 108 and had your stop at 125, 126. LMND. This one, a lot of people like this company. I think it's because of the symbol, lemonade. It just sounds cool, I guess. But look at these rallies. And these are great rallies, which, by the way, is a nice measured move in here. A to B, B to C, C to D. But anyways, with a declining 200-day moving average, don't trust those rallies. Meta was in an awful downtrend for most of 2022. And coming into 2021, 2023, you didn't have to buy the low to make money. In fact, it gapped up over here. It pulled back. The 200-day moving average flattened out. You might have purchased here with a stop under there. You might have purchased here with a stop under there. You might have purchased right here with a stop under there. There's still plenty of time to make money. You don't have to buy it down here, because every time you try to buy down here, you've probably tried to buy it here, 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 and there, and it just doesn't make sense. This is the institutional line. It tells you that the big money is accumulating, buying stock, and moving prices higher. That occurred in just March of this year for Microsoft. It made the higher high above that 200-day moving average, which had flattened out at about 275. and it's continuing to make a pattern of higher highs and higher lows. Now, it just broke that pattern, and maybe you would have gotten stopped out. But what's wrong with that trade? NVIDIA, big uptrend into March of last year, and then it fell apart, and the 200-day moving average began to decline. Great company. All you can say about that, unless you're dollar cost averaging and you're playing some kind of other different game, it still doesn't make sense. Wait for the stock to break beyond resistance, make a higher high above a flat to rising 200-day moving average. And even if you bought it right here on this earnings report, or right here, or just recently, you're still in a primary uptrend, and there's money to be made on the long side. When it's in this trend, the uptrend above a rising 200-day moving average, you still don't want to buy dips. You want to buy strength after the dip. You want to buy here. You want to buy here as it makes these higher highs, and then manage risk, because things can and do fall apart. Penn, another terrible stock. Great, story. Who cares? Gaming, whatever, gambling in that. Declining 200-day moving average. It's just a waste of time from the long side. Wait for that 200-day moving average to flatten out and for buyers to regain control before you get involved. Palantir, I saw so many people buying it all the way down. It rallied above the 200-day moving average, and the 200-day moving average was starting to flatten out. It said, start paying a little bit more attention. Then on this gap, it really started getting going. I probably should have put this green over here a little bit further, but even if you got involved right here with your stop under there, it's still in a great uptrend until maybe this higher low was broken. Now it's a little bit suspicious. It's probably going to need some time to heal. Peloton, garbage stock. They may, everyone knows what they do, and they were a COVID play. Big rally here, 8 to 16, 18, 20. Yes, it's a short squeeze, but it's a knee-jerk short squeeze. It's not a structural shift. If it was to have a move over here and that 200-day moving average flatten out, that would be a structural short squeeze, because at that point, the 200-day moving average would be rising. It would show the institutions are in control and defending it. PayPal has been another one. And here you can see the 200-day moving average flattened out, but prices were below it. So it's still highly suspect that you don't want to buy stocks below a 200-day moving average, even if it's, in this case, just starting to flatten out. It's a garbage stock. It continues to be garbage. It just made a new low 2 weeks ago. Target, it gapped lower and people thought it was a bargain, and it's just frustrated more people than anything. And here, just this last week and a half, it made another new low. Uber was a terrible stock. I'm along it right here, and my stop had originally been there. So I didn't get involved down here. I don't care. I'm a trader. I'm looking to get involved in, get those gains that occur over several days and maybe a couple weeks. But while it's below a declining 200-day moving average, it's guilty till proven innocent. And then when the 200-day moving average finally began to rise, well, it was too far extended to buy. Look at, again, where had it come from 24 to 38? That's a 50% move, more than 50%. So wait for it. Let it settle down. It came in and touched that 200-day moving average perfectly. And maybe you bought it here, or maybe even on that day. Wherever you get involved, just know where your stop is going to be as well. Victoria's Secret, this one has tried to straighten itself out. And maybe over here, if it had done something like this, then perhaps, breaking above there, the 200-day moving average would have been able to rise. But instead, just lower highs and lower lows in a downtrend. Wolf, this one has been, previously a huge winner, but the sellers are in control. It's a garbage stock. Forget about the company. Forget about Zoom. It still has a declining 200-day moving average. Forget about people who say they have a $1,500 price target or whatever it might be. It's in a downtrend. It's guilty until proven innocent. So again, here's just a couple of little reminders about the 200-day moving average. I hope that was helpful. And I actually asterisked the 200 because the same principles apply as you always hear me talking about on a 5-day moving with a 5-day moving average. Be aware of the direction of the 5-day moving average. Be aware of where we are in relation. How far has it come? Anyways, I hope that helped. Give me some feedback and let me know. Thanks.